Capital gains. Capital gains.
Capital gains.
Capital gains.
Capital gains.
Capital gains.
Hi everyone, this is Shalini Gera. The government has made changes in the capital gain tax rates of various asset classes. In our last video, we talked about the capital gain tax impact on real estate as an asset class, and today we aim to simplify the capital gain tax structure impact on equity investments. In today's video, let's understand what is the capital gain tax impact that the government has brought about for equity. Secondly, let's understand what is going to be the tax impact through an example on your equity investments. And thirdly, how do we offset this tax impact? So here you can see that initially before July 2024, the long-term capital gain tax was 10%, and this has been revised to a rate of 12.5%. The short-term capital gain tax rate was 15%, which has been now revised to 20%. The holding period is kept at 1 year, and it is also important to note that there has been a change in the exemption amount. Initially, the long-term capital gain exemption was 1 lakh rupees, which has now been increased to 1.25 lakh rupees a year. That means that the tax rate on both short-term as well as long-term capital gain has definitely been increased, but at the same time, there is also an increase in the exemption. Now let's understand through an example what is the exact impact on the tax that you will have to pay. Here I have taken an example of 10,000 rupees as a monthly SIP being done. Now, whatever be the monthly SIP amount, there is definitely going to be an increase in tax. Let's understand what that is. If the return is assumed to be 12% per annum, my annual invested value becomes 1.2 lakh rupees. This invested value in 5 years becomes 6 lakh rupees. Calculated at the rate of 12% per annum, the future value of this 6 lakh rupees is 8.5 lakh rupees, which means that the gain is 2.5 lakh rupees. Earlier, I had an exemption of 1 lakh rupees, which means my net gains after exemption are 1.5 lakh rupees. The tax rate was 10% per annum, which means that the tax amount was 15,000 rupees and the post-tax return was 2.38 lakh rupees. Now you can see that the tax rate has been increased to 12.5% and the exemption amount has also been increased from 1 lakh to 1.25 lakh rupees. The gains remain the same at 2.5 lakh rupees, but the exemption amount has increased from 1 lakh to 1.25 lakh rupees, which means that after the exemption, the net gain that remains is 1.2 lakh rupees. At a tax rate of 12.5%, the tax amount comes to be 16,000 rupees, which means that my post-tax return is now only 2.37 lakh rupees. That is a definite increase in the tax that you will have to pay to the government. So what do you do to offset this? The simple thing that you can do in order to offset the additional taxes that you are paying is to increase the net return of your portfolio. So I'm going to give you very simple measures that you can easily implement in your portfolio in order to increase the net rate of return over the long term. The first measure that you can adopt is by adding small and mid-cap companies in your portfolio as compared to purely large-cap companies. So if your goal is long-term in nature and your risk appetite is also allowing, then by all means add mid and small cap companies instead of just large cap companies to your portfolio. This is because mid and small cap companies, because of their smaller size as compared to a large cap company, will have the capacity to grow in size at a much faster pace. Let's stick to the fact that this mid and small cap company will have the capacity to grow at a much faster rate as compared to a large cap company, and hence the growth that a mid or small cap company can give you in terms of its stock price will be much larger as compared to a pure large cap company. Here is a very simple example. I'll take two Tata stocks belonging to the same group, that is Tata Motors as well as IHCL, that is Indian Hotels Company Limited. Now here is the performance of Tata Motors. In the past 1 year, the stock has given a 54% absolute return. The IHCL stock, which is a mid-cap company, has given a higher performance of approximately 61% absolute return. So this is exemplifying that a mid-cap and a small-cap company will be able to grow at a much faster pace as compared to a pure large cap company and will be able to deliver better returns to your portfolio. Moving on to the second measure that you can take, always invest in stock markets whenever there is a price correction. This is because whenever you are investing into the equity markets during a price correction, you will be able to buy good quality stocks at a discounted price. Now, whenever the markets will recover, the benefit will compound because you bought these stocks at a very cheap price, and now after the market recovery, the stock price has increased. The third simple measure that you can take in order to add returns to your portfolio is to keep your portfolio very relevant as per the changing market conditions. During different market conditions, different kinds of sectors will achieve highs. In order to give you an example, in 2017, the auto sector was doing very well. You can see a peak over here. In 2016, the financial services sector was doing very well. Again, in 2016, FMCG was doing well. 2019, IT peaked. 2015, pharma had peaked. In 2024, reality had peaked. So what can you possibly do in order to make your portfolio relevant to the current market conditions? Opt for something which is known as a business cycle fund. A business cycle fund is going to buy stocks which are relevant as per today's time. So a good business cycle fund worth its salt would have invested in the auto sector in 2018, and when the sector would have peaked from 2017 to 2018, they would have exited the sector, booked the profits, and possibly moved to an IT sector. In this way, a good business cycle fund will always be in a position to be a part of the right sectors at the right point of time. So this is Shalini Gera. I hope and I do believe that this financial content added value to your financial planning. If your thought is the same, please do hit the like and the subscribe button. Do let us know on what other financially relevant content would you want us to talk about. Bye-bye.